Hi, in this lecture, I'm going to talk to you about how to manage risks while investing. First, let's understand why to manage before we look into how to manage. Now, as per finance theory, higher the risk, higher the potential return, which also means there is a higher potential for loss. Oftentimes, the problem with people is that they have a fear of loss which is greater than the belief in return. The problem with greed of making a fortune fast. There are several scammers who try to promise people the world, and they say that make so much money in 6 months, double your money in 3 months. There are plenty of such scams. I don't have to tell you about these. We are all bombarded by these scams online. Next is the inverse relationship between age and risk. So the older the individual, the lesser the risk appetite can be. The younger the individual, the higher the risk appetite can be. Next is setting the risk appetite and asset allocation. There are several factors in terms of risk appetite, and we're not going to go into all of those, but a risk appetite is essential in determining what sort of assets you're going to invest in and how much you're going to invest in. In fact, one of the investors that we had a look at in the previous lecture was Benjamin Graham. And according to Benjamin Graham, it's more important to manage risks than to set targets for returns. Because if you manage your risks right, you're going to make returns more than what you, or at least match your expectations. Now let's look at how to manage risk. So the first thing is choosing the right opportunities for investment. Again, this is very subjective. It depends upon your income level, it depends upon your age, and what your propensity for risk is. And so for one person, it's a certain opportunity might look an opportunity, for another it might look a challenge. So this is something which needs to be looked at carefully. Next is picking the right industries and offerings to invest in. There are several sorts of assets in which you can invest in and several industries which you need to invest in. One of the things which every individual needs to do is stay updated with industries that interest them or that they understand. If, for example, if you are employed in a certain industry and you know that industry well, keep your ears open for any news pertaining to that industry or any other allied industries. So that's a good starting point. And the kinds of offerings that you have in such industries are the normal ones, which are stocks in companies, bonds, and mutual funds. So what are stocks? Very briefly, stocks are equity shares which are issued by companies, and when you buy them you get a certain amount of share in the company. You can either buy stocks in the stock market, which are secondary, which is known as a secondary market, or you can buy stocks through IPOs. We'll cover stocks separately, so if this seems a bit confusing to you, never mind, it's completely normal. Next is bonds. Bonds are debt instruments. It's like you giving a loan to the company and you earn an interest in return from the company. Then there are mutual funds. Mutual funds are portfolios managed by separate companies altogether who buy a lot of stocks or a lot of bonds or a mix of both and offer a blanket security to people. The advantage is you don't really need to worry about your portfolio. The mutual fund managers are paid to do that job, but the flip side is you're obviously covering their overheads, and the amount of return which you can make from mutual funds is obviously lower than what you can probably make through investing in stocks and bonds. Yeah, now that was a bit too much for that one point. Next is asset allocation and portfolio creation. So this is spreading funds evenly or in various manners over several smaller investments rather than one investment. Then is calculating and managing portfolio risk. This is slightly technical in nature. We probably will not go into the actual calculation, but yes, I will touch upon the theory in this course. Next is monitoring for any changes in qualitative or quantitative characteristics of portfolio assets. Now, there are separate lectures for covering qualitative and quantitative characteristics of portfolio assets, but the crux is analysis needs to be done today an analysis needs to be done of changes between today and tomorrow, over the course of time. Well, that's it that I wanted to share about managing risk of portfolios or for investing. I will see you in the next lecture. Thanks for watching.